The S&P 500 is currently charting a course towards its third consecutive year of double-digit gains, a testament to the powerful bull market momentum that has defined the recent economic landscape. In fact, the index has recently closed at record highs, leaving many investors wondering about the source of this seemingly inexhaustible energy. A significant portion of this upward drive can be traced back to the explosion of interest in artificial intelligence. Over the past couple of years, investors have flocked to AI-centric stocks. Many of these companies are heavyweights within the S&P 500, meaning their performance can substantially sway the entire index's direction. We're talking about market leaders such as Nvidia and Alphabet. For instance, AI stocks that have posted remarkable gains this year, climbing more than 30% and 60% respectively. The intense investor focus on AI players stems from a widespread belief that this technology represents a fundamental game-changing paradigm shift, much like the internet did a generation ago, or even further back transformative innovations like the telephone or the printing press. In the context of artificial intelligence, analysts and business leaders widely expect it to revolutionize business operations, making them significantly easier, faster, and more cost-effective. Beyond efficiency gains, AI is also a powerful catalyst for innovation, opening up new product categories and business models. This incredible potential has already begun to supercharge the earnings and, consequently, the stock performance of a select group of pioneering companies, solidifying its status as a technology with immense promise. Adding fuel to this fire, a more accommodative interest rate environment has also played a crucial role in bolstering investor optimism over the past year. The Federal Reserve has embarked on a series of rate cuts, with the most recent reduction occurring just this month, signaling a shift in monetary policy. Lower interest rates translate directly into lower borrowing costs for corporations, enabling them to invest more readily in growth and expansion. Simultaneously, it increases the purchasing power of consumers, stimulating demand across the economy. This combination creates a highly favorable backdrop for corporate earnings growth, further encouraging investment and market enthusiasm. This powerful confluence of market momentum, driven by both technological innovation and monetary policy, has now led the stock market to exhibit a behavior so rare it has been witnessed only twice in the last 153 years. And if we look to history, it provides a very clear signal about what this could mean for the market in 2026. The AI boom isn't just hype. It continues to march forward with undeniable force. The investor enthusiasm we've seen over the past couple of years is firmly supported by solid, tangible earnings growth from the leading technology giants. This is coupled with sustained and massive spending in AI infrastructure and development. Companies at the forefront of providing AI products and services, from the foundational hardware supplied by Nvidia to the cloud platforms offered by Amazon, and the sophisticated data analytics from firms like Palantir Technologies, have all reported enormous, and in many cases, unprecedented demand. Their corporate clients are rushing to them for assistance, seeking to either build their own AI platforms from the ground up or to effectively apply artificial intelligence to their existing business processes to gain a competitive edge. This is not a speculative future trend. It is a present-day reality driving significant revenue and profit. This intense earnings-backed rally has culminated in a truly rare phenomenon in the market, a situation that has only been observed on two other occasions in modern financial history, once at the peak of the dot-com bubble in 2000, and again right now. This phenomenon relates directly to the cyclically adjusted price-to-earnings, or CAPE ratio, of the S&P 500. This valuation metric, often referred to as the Shiller P/E ratio, is a powerful tool because it is inflation-adjusted and smooths out short-term volatility by considering average earnings per share and stock prices over a 10-year period. Recently, the S&P 500's CAPE ratio surged to a level of 39. To put that into perspective, the only other time this metric has surpassed this level was over 2 decades ago, during the frenzied peak of the dot-com era, a time when the stock prices of internet companies soared too. Astronomical valuations, often with little to no earnings to support them. Now, hearing this, you might immediately think, uh-oh, are we in an AI bubble? Is history about to repeat itself in a painful way? That's a valid concern, and it's a question that has certainly worried many investors in recent weeks. However, the evidence does not strongly support the classic bubble narrative. A crucial difference between today and the year 2000 is the underlying fundamentals. The current AI boom is being driven by solid, established companies with immense financial strength and the capacity to make substantial long-term investments in this new technology. As I mentioned earlier, their soaring valuations are, for the most part, backed by real, continuing earnings growth. This is not a story of speculative ventures with no path to profitability. Still, we cannot ignore what the Shiller-Cape ratio is telling us. It is an unequivocal signal that stocks, by this historical measure, are expensive right now. In fact, they are at their second highest valuation level ever recorded. And history is very clear about what may happen in 2026. A consistent pattern emerges when we examine past market cycles. After every significant peak in valuation, the S&P 500 has, at some point, gone on to fall. If you look at the historical chart of the Cape ratio and the subsequent market performance, this trend is visible time and time again. Considering the sky-high level of valuations we are witnessing right now, if this historical precedent holds true, the S&P 500 is on a trajectory that suggests a potential decline next year. But before you rush to sell your portfolio, there are a few critical things to keep in mind about using history as a guide. First, and most obviously, history is not a perfect predictor, and its timing is notoriously imprecise. While it has a mathematical certainty that the market cannot climb continuously forever and declines will eventually happen, this corrective movement could come much later than the historical pattern suggests. The market can remain at elevated valuation levels for extended periods. Second, even if the S&P 500 is on track for declines in 2026, this does not mean the entire year will be a write-off or that the index will end in the doldrums. It is entirely possible, and even likely, that stocks could pull back for a period of a few weeks or a few months, only to recover and resume their upward trend within the same year. Short-term volatility is not the same as a long-term bear market. And finally, this brings us to the most important point of all, and it's something that history has, without fail, always been right about. After every single decline, correction, and even the most severe market crashes in its history, the S&P 500 has gone on to recover its losses and advance to new highs. Every single time. This is the unwavering, long-term upward bias of the market, driven by human innovation, economic growth, and corporate profitability. So, how can you, as an investor, benefit from this ultimate truth of the market? The strategy is simple, though not always easy to execute. You benefit by buying shares in high-quality companies and holding on for the long term. By focusing on the underlying business and maintaining a long-term perspective, you position yourself to score a significant win, no matter what the market does in 2026 or any other single year.